This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Let's move on. What does working 3 show us? What's working 3 about? Consolidated retained earnings. Well, is that not what the statement of comprehensive income is going to do? Well, actually, no, it's not, but it's going to get a long way towards it. It's not going to actually show us the bottom figure, but we can get to the bottom figure by adjusting the statement of comprehensive income. So this is actually a presentation exercise. Statement of comprehensive income is presentation. We know what the consolidated retained earnings figure is going to be because we've worked out working 3. So that's not a problem. All we're now faced with then is the problem of presentation and how we get to that bottom figure in working 3. Revenue, H plus S. Cost of sales, H plus S. That gives me gross profit. Admin expenses, H plus S. Distribution costs, H plus S. Finance charges, do you want to guess? H plus S. Income from subsid, ignore. That's going to get me down to profit before tax. Tax, H plus S. That's going to give me profit after tax. What's the next line? Not dividends, no. No, dividends will be in statement of comprehensive, statement of changes in equity. What's the next line? Do we own 100% of S? Probably not. What's the next line? It's a good answer, but that's also not right. The next line is that, and then the line after is that. That's the end of the statement of comprehensive income. That's it. This figure, profit after tax, is going to go into statement of changes in equity. And in statement of changes in equity, then you'll do the transfer for the NCI. Then you'll do the dividends for the parent and for the non-controlling interest dividend. But that's the end of the statement of comprehensive income. What's the key word? What did we start with yesterday morning? What's the big word in consolidations? Control. Yeah, control. We might not have owned this subsidiary for a full year. We may not have owned the subsidiary for a complete year. So it's actually not H plus S, it's H plus S time apportioned. Only bringing in the post-acquisition results of S. H plus S time apportioned. Just have a look at the question Mantus and Rarcus on page 72. What's the revenue figure? How many? 38. 26 plus 12. Cost of sales? Dividend from subsid? Nothing. Ignore it. Profit before tax, therefore 21. What's the tax figure? $7.5. Profit after tax, 13.5. Dividend. H only. NCI is in working 4B. But we've not done working 4B yet. But we have reached the end of the comprehensive income statement. Working 4B. What did our NCI want for the balance sheet? What did they want for working 4A? They wanted their share of subsidiary net assets at fair value at the year end. What do you think they want from the income statement? Their share of, they want their share of this year's subsidiary adjusted time apportioned profit after tax. Their share of this year's subsidiary adjusted time apportioned profit after tax. In Mantus Rocus, how much are you going to give the non-controlling interest? Mantus and Rocus, how much are you going to give the NCI? There's no adjustments, there's no time apportionment. Just give them their share of profit after tax. Yep. Ilse? 700. Yep. 700. Subsidiary, profit after tax, their share. 20% of 3,500. Working 4B looks like this. I'm sorry, do you see anywhere where you could imagine two easier marks? There may be adjustments. There may be, well, certainly not in this question. Okay, well, I'm going to go back up here and I'm going to extend beyond where we got to. I'm going to give the non-controlling interest their share, and that's going to leave me with 7.8. Any chance you can prove that? That should be the figure at the bottom of working 3. That should be the figure at the bottom of working 3. Further question, 12,000 and 3,500. Dividends, 5,000 and 2,500. Retained is therefore 7 and 1. The 80% dividend that we're due to receive from Rockus is already in our income statement. It's already there in our income statement. So when I take 12,000 per the question for Mantus, that includes their 80% of this 2005. Correctly. Quite right too. There's no pre-acquisitions because this is only for 1 year. So it's the full year, and we bought on the 1st of January, so the entire 3,500 is post-acquisition. 2,500 is paid, so post-acquisition retained is 1,000. And our share of that is 80%. And that's the proof. All right. Back up there. If I tell you that during the year the parent sold to the subsidiary $18,000 worth of goods, we're no longer on Mantus Rockus. The parent sold to the subsidiary $18,000 worth of goods at invoice value. As I'm the parent, I'm going to raise an invoice on you for 18,000. How much did you buy from me? If I sell 18,000 to you, how much did you buy from me? Come on, this is not a trick. BPP show it differently. BPP say, if I sell 18,000 to you, it could be that you've only bought 16,500 from me. I'll explain why. But if I sell you 18, how much did you buy? 18. Okay, it's in my revenue, it's in your cost of sales. Cancel it. Get rid of it. Eliminate the intergroup sale. Dollar for dollar. Don't think. Don't stop. Don't pause. Just do it. Eliminate the intergroup sale. Now we need to stop, because I'm going to tell you that there's a PUP within some of this inventory, some of this sale that I've made to you. There is a PUP. And the PUP is 1,000. I need to adjust for that unrealized profit in the income statement. So debit the income statement, credit provision, credit inventory. Okay? Where in those top 3 lines am I going to make a PUP adjustment? Revenue? Cost of sales? Where? Cost of sales. Well done. Cost of sales. 1,000 adjustment is going to go against cost of sales. Plus or minus? Plus. It's going to increase the cost of sales and therefore reduce the profit. It's an unrealized profit. So cancel the trade Then think about PUPs. Calculate your PUP and add it to cost of sales.